Starbucks in fiscal third quarter 2025 delivered a mixed performance that underscores both the strength of its brand and the challenges it now faces navigating inflation, weak comparable sales, and investment drag. The company reported consolidated net revenue of about $9.5 billion, up around 3% year-over-year. While revenue growth is modest, it exceeded many analyst estimates, showing that Starbucks can still push sales through scale and expansion. Digging into the segments, in North America, Starbucks posted net revenue of about $6.9 billion, up roughly 2% from the same quarter a year earlier. That growth was supported by net new company-operated store openings, even as comparable store sales declined by approximately 2%. Transactions were down by about 3%, partially offset by a 1% increase in average ticket. In the international segment, net revenue increased more robustly, rising about 9% year-over-year to just over $2 billion. That performance was aided by new store growth overseas, favorable currency translation, and contributions from licensed operations. The channel development businesses, Star Retail, Packaged Goods, and Global Coffee Alliances, also performed well, with net revenue up about 10% thoroughly, $483.8 million. On profitability, Starbucks' operating income in the quarter fell to approximately $918.7 million, down materially from the prior year. Its operating margin contracted to about 10.1% on a consolidated basis, reflecting deleveraging pressures and investments connected with its Back to Starbucks strategic plan, including added labor, leadership experience initiatives, and elevated general and administrative spending. In North America, operating margin declined substantially from prior year levels as those investments weighed on returns. In the international segment, margins also compressed as promotional activity increased and expense leverage weakened. The channel development business remained strong on margin relative to others, but even there, margins declined due to mix shifts, cost pressure, and higher global product input costs. Earnings per share was reported at 50 cents, a steep drop from the same quarter in the prior year, reflecting that expense deleverage and investment drag. That result missed many expectations, triggering negative sentiment in the aftermarket. Starbucks management has emphasized that this is part of a transition period under the Back to Starbucks plan, aimed at restoring brand experience, operational discipline, and long-term comp growth. Beyond the raw numbers, Starbucks is undertaking a bold repositioning. Under CEO Brian Niccol, the company is stepping up investment in store experience, operations, menu refinement, and digital integration. That includes efforts to shorten wait times, improve employee staffing and scheduling, adjust the product mix to more premium items, and lean into loyalty and rewards. Starbucks is also refreshing store formats and planning capital investments in over 1,000 store remodels over the coming years to bring greater consistency and premium feel. But Starbucks is also reacting to headwinds. The US consumer is under pressure from inflation, wage growth, and weaker discretionary spending, which affects frequency and basket size. The decline in comparable transactions in Starbucks' core US market is a red flag that even in its strongest markets it cannot fully rely on expansion to hide stagnation. International markets carry their own risks: currency swings, local competition especially in China, and regulatory or supply chain disruptions. Speaking of which, Starbucks is facing potential import tariff pressure in Brazil on coffee that could raise input costs if not hedged or mitigated. Operationally, Starbucks is in a delicate balancing act. The investments under the turnaround plan are necessary to maintain the premium brand aura, but they also erode near-term margins. The company has to execute precisely to win back consumer loyalty without alienating cost-conscious customers. Execution risk is real. Missteps in store rollouts, inconsistent service quality, or failed menu experimentation could undermine the strategy. Moreover, closing underperforming stores or optimizing the footprint creates friction. Some closures are already underway, and the company is cutting corporate roles and consolidating to reduce overhead. From a valuation perspective, Starbucks currently trades at a premium relative to many consumer and restaurant peers, reflecting its brand strength, scale, and perceived defensibility. But the premium is now under pressure by compressing margins and slowing underlying growth metrics. Investors will demand visible evidence of margin recovery and sustainable comp trends before reinstating a full premium multiple. The path to re-rating lies in proving that revenue and comp growth can return, and cost optimization does not undermine customer experience. Leading indicators to watch quarter to quarter include comparable store sales trends, especially in US and China, transaction growth, ticket growth, margin progression in each operating segment, capital expenditure on store remodels, remodeling ROI, changes in loyalty program engagement, and spend per rewards member, and how Starbucks manages input cost pressures, especially coffee and supply chain costs. On the downside, inflationary pressure in wages, utility, rent, and commodity inputs, plus weak consumer sentiment, represents a serious drag, especially if Starbucks cannot offset via pricing or efficiency. In terms of scenarios, in a bullish case, Starbucks succeeds in reversing transaction declines. Its investments yield a stronger brand pull, margins recover, and same-store comps return to positive growth. Such a scenario could re-accelerate earnings and support multiple expansion. In a base case, Starbucks returns to modest positive comp growth with gradually recovering margins over several quarters, delivering steady but not spectacular returns. In a downside case, comp declines persist, margin pressure deepens, and investors punish the valuation, leading to sideways or declining equity performance. My recommendation is that Starbucks is a cautiously optimistic hold or modest buy for long-term oriented investors who believe in brand durability and have patience through execution risk. It is not a short-term growth bet, and the volatility inherent in its turnaround means you should size conservatively and revisit your thesis each quarter. Focus on momentum in comp trends and margin recapture as your triggers for adjustment. If you found this useful, please like, subscribe, and hit the bell so you don't miss our deeper multi-year models and growth comparisons among consumer and restaurant names.